Hello everybody, welcome to join our Bursa Malaysia webinar. And today our topic is portfolio timing. Now sometimes knowing what to buy may not be enough because if you can know when to buy and when to sell, that's even better, isn't it? So today we're going to talk in depth about how to time a stock and also how to time your portfolio. So today we are very excited to have invited a very distinguished guest, David, who will share with us about portfolio timing. Now, as usual, the first thing I want to talk about is disclaimer. So whatever we share in this webinar is only for educational purpose. In no way that I give any buy or sell recommendation. Now, even if David do any case study, we don't give any buy or sell.
We do a lot of case studies.
Yeah, but we won't give any. It doesn't mean that we give any sell or buy call. So if you decide to buy any stock, sell any stock, you do it at your own risk. Okay. Now for this Bursa Malaysia webinar, we designed for the whole year, and this is the 9th session for this webinar series in the first Tuesday of the month. And then for the second Tuesday of the month, we will be doing the Chinese webinar series. And next week, we'll be talking about a technical masterclass, which in Chinese is called 技术形态学堂. So if you want to learn about technical analysis in Chinese, please join our next Tuesday webinar. And then for our advanced or intermediate webinar is on the 3rd Tuesday of the month. So we are coming to the month of November, which is the second last month of the year. So we still have a few more webinars to do for Bursa Malaysia. Then we'll conclude this year Bursa webinar series. Now let me introduce to you the distinguished speaker next to me today, and he is none other than David Poh. Okay, so if you have watched our webinars before, he has also appeared on our webinar. On the first appearance was talking about the portfolio management, the essence of portfolio management. Then subsequently, he was invited to share about the science of buying and the art of selling. Now today, he's here with us to talk about the portfolio timing. Now he is an engineer by training. He has served in the engineering and telco sector for several years before he moved on to join a equity research company as a director. And then now he is the founder of Spiral Thinker Alliance, which is a group of like-minded investors who come and do research together and share analysis and do some kind of corporate visit.
We're all private investors.
Private investor, precisely. So he has many years of experience into a researching company. So today he's with us to talk about how to time a stock, how to time your portfolio. All right, so David, over to you.
Thank you, Chun Xian. Thank you once again to Live Chain and Bursa Malaysia to invite me over to talk about topics about value investing. Just to correct you for a bit, so today the topic is called portfolio timing. So it's not so much about stock timing.
Yeah, because I saw there's stock timing there.
I will introduce a little bit about stock timing and how that differs from portfolio timing. So if you can see on your screen today, tonight I'm going to go through several topics. We're going to start with a little bit of introduction of what we went through, as what mentioned by Chun Xian. Basically, we are trying to build a story here. All right, step by step from the beginning. We talk about until where we are now. Then I'm going to talk a little bit about the difference between what is the timing for stocks and timing for portfolio. They are quite different, but they're useful in their own sense. Then we're going to talk about the tools or the parameters that we can use to do portfolio timing. So including portfolio PE, or what we call the EY, earnings yield, and the portfolio DY, or the dividend yield. Then we're going to go through an even more interesting topic using the 52-week volatility range indicator. All right, and then we're going to seal it off with a very interesting case study on the real portfolio to discuss the art of rebalancing. And this is where portfolio timing is very useful. Okay, now without much further ado, I'm going to start. So let's do a quick recap on what we went through before. Now, actually, before I'm sure that I hope that you have joined my previous webinar sometime in June, where I talk about the science of buying and art of selling. But before that, I had another topic. I think it was last year.
The essence of portfolio management.
The essence of portfolio management. So basically, there is an opening introduction for why portfolio management is important. Now, as long as you have more than 2 stocks in your hand, right, you need to know how to manage your portfolio. It's not only for fund managers. In fact, everyone, if you're investing in the stock market, you should have a portfolio mindset if you're investing for the long term. Then after the introductory session, I talk a bit more in depth about the science of buying and the art of selling. Okay, so in that topic, we started off with talking about how to set up a goal, because that is your barometer or your GPS, all right, on how to work on a portfolio. Then we talk a little bit about the science of buying, as well as the art of buying, the art of selling. And we actually supplement with a lot of case studies in that seminar. Now, if you remember correctly, this is where rebalancing plays a very important role, because it is always impossible or highly unlikely that we are able to buy at the bottom and sell at the top. Okay, because imagine you may be able to do it once or twice, but imagine if you're investing for the long term and you're investing for years and years to go, right? It is almost impossible for us to do this every single year. So the rebalancing of portfolio is a very important aspect of your portfolio management. For today's webinar, the focus is on actually on the timing of the portfolio. As I mentioned before, I'm going to go through several topics looking into portfolio PE, portfolio price over earnings ratio, the dividend yield of the portfolio, all right, not the stock, but on the portfolio level. And then the pure timing indicators using the 52-week volatility, as well as the art of rebalancing. Yeah. So without much further ado, let's go to the first topic, which is stock timing versus portfolio timing. So what's the difference here? Now, I'm sure a lot of the listeners or viewers today, they are very familiar with how to time a stock. Okay, I'm sure there are a lot of webinar topics that talk about this as well. But basically, the timing of the factors that determine the stock timing basically falls into 2 categories. First, the fundamental risk, and then the timing risk. Okay, so in simple terms, when we talk about fundamental risk, we look at this stock represents a business, right? So where in the current cycle that it is at? It could be during expansion mode, peak, contraction, or the trough. All right. So depending on where the business is heading right now, then you can use this information to time your stocks, whether you should be accumulating now or you should be taking profits. Other than that, external factors play an important role as well. So the interest rates and the market discount rate, or the market risk on or risk off sentiment, that will actually impact the valuation models or the valuation of the stocks. So that is important as well. Then last but not least, external factors like geopolitics, government stability, or even external factors like natural disasters. All these, it will impact the stock as well. In a way, it impacts the business, then it will impact the stock price. Then on the timing risk part, it's very simple. As value investors, we don't look at the price. We mostly focus on the yields. So when it comes to yields, if you have followed through my previous webinars, we talk about earnings yield, right? Earnings yield is EY, which is the inverse of PE. All right, basically the earnings per share divided by price, then the dividend yield and the cash flow yield, and so on and so forth. Then also we talk about the ABC, which is the average balance cost per share, and this is what I shared during the essence of portfolio, and this is an absolute important indicator because our as long-term investors, our focus or our priority is to reduce our cost per share over the long term. Now, Chun Sian, would you like to have free AHS shares?
Sure.
Right. So what's the meaning of having free AHS shares?
Yeah. If I buy AHS share at 190 right now,
yeah,
I sell half of my holdings at 380. I will have free shares.
Yes, correct. So the balance is free. So what can you do with these free shares? It's basically, you have no more risk because you're taking all your money back, and then you just let the management run the business, right? Give you dividends every year, right? So that is important for us, the ABC. Then the other technical indicators, which I'm not going to talk about, but a lot of people, they forgot about their personal risk tolerance or investment objectives when it comes to the stock timing risk. Now, for example, if before we go into the investment thesis, we normally say, oh, you've got to set a price or a level where you need to take profit, right? But most people don't do that. So of course, because they think that they want to sell at the peak, at the highest price, which, as I mentioned before, is highly very challenging to do that consistently. So you've got to have a plan, all right, based on your own risk appetite or your investment objectives. For example, like you mentioned just now, if you want to go into a stock AH at 190, so say more realistically, say I want to, my target is 230. 2 ringgit 30 cents, right? So we got to set our objectives or plan already to take profit at that price. Okay, so this is more about the top stock timing factors. Now imagine when you have a few stocks in your hand, so in your CDS portfolio, right? So each of these stocks, you have to take care of these risks, all right? These fundamental risks, these timing risks, and as collectively as a group, you can actually view these two risks on that level as well. So not on the individual stock basis, but on the portfolio level. So that is why, okay, basically this is, price chart. So the portfolio timing, again, we look at it from two different angles, which is what is the fundamental risk and what is the timing risk. Now, very simply say, when it comes to portfolio's fundamental timing risk, it's basically, in my opinion, how much weightage is the stock on your portfolio and what's the cash balance that you have right now. Now, for example, if you do not track your portfolio, right, you never know that perhaps you got 80% invested, 80% of your money invested in one stock like Asia. Now, that to us is a concentration risk. Meaning, of course, if Asia goes up, you're very happy because most of your money is invested in this stock, right? But what if the stock goes down 5%, 10%, 20%, it will drag down your portfolio performance. So portfolio is, as you have learned in my previous webinars, having a portfolio is to diversify your risk, not to maximize your profit. So here, portfolio weightages play an important role. I'm going to talk a bit more about portfolio weightages later in the webinar. Now, then the second one is timing risk. Again, like the stock timing risk. Now, this one, instead of looking at the individual stock, we're looking at the collective group of stocks. All right. So these stocks, depending on the weightages, will contribute certain weightages on the portfolio earnings yield, portfolio dividend yield, and so on and so forth. Okay. ABC plays a very important role in portfolio management as well. And again, as I mentioned before, your risk tolerance and investment objectives. Now, in that, I'm going to talk a bit more about the investment objectives differences between stock level and portfolio level. Remember, if you have joined my previous webinars, as long-term value investors, we want to double our money every, say, 4, 5, or 6 years, depending on your own risk tolerance, right? So if, for example, if you want to double your portfolio every 5 years, so you start with 100,000, for example, today, then your target is to double that to 200,000 in 5 years' time. So in other words, our objective is to grow our portfolio 15% per annum, all right, compounded. So that's on the portfolio level. But what you put in your portfolio, the stocks, the component stocks that you put in your portfolio should reflect this objective as well. Okay, but of course, as we have seen in the earlier webinars, not all stocks behave the same way. They do not have the same characteristics. They have different business cycles. They have different risks. All right, so you have to understand that. Then you can structure your portfolio, to have maybe more weightages on certain group of stocks and less weightages on certain group of stocks. Or you want to avoid certain group of stocks altogether. All right, as a portfolio strategy. Okay, so that's the general laydown on what I'm going to talk about this tonight. So this is basically a visual or sample of how we measure our portfolio performance over time. Now, interestingly, if you have followed the previous webinar, this portfolio was the inception of this portfolio was presented in the previous webinar. You can go back and download the slides again. It is on page 14. The inception, there are 6 stocks here, if I remember correctly. It started sometime in January this year. So we are about 9 months, we are about 10 months into this portfolio now, and the portfolio has done pretty well. Well, for value investors, it's pretty well because we are close to hitting our 15% target already. But of course, you are a speculator, or if your portfolio KGA target is 20-30%, then this may not be satisfactory to you, but it is quite satisfactory for us. So this is the end in mind that we're trying to achieve. So I'm going to talk a little bit more about this, come back to this portfolio again when we talk about the art of rebalancing later. All right. Okay, so let's start with what is a portfolio PE and DY. Okay, to recap, PE stands for price over earnings ratio, or the inverse of EY, which is earnings yield, and DY stands for the dividend yield. Okay, now let's take a look. Let's take a walk down the memory lane to define what is PE again. So as I mentioned, PE simply means stock price divided by earnings per share, and the earnings yield is the inverse, right? So you need to multiply that by 100% so that we can compare the earnings yield with maybe other asset class like your FD, your rental yield, so on and so forth, right? Now this is on a stock level. Okay, for example, if your stock price is $1 and your earnings per share is 5 cents, so you plug that into the formula. The PE for this stock at this price is 20 times. So theoretically, the business you have to lock your money into this business for 20 years before you can recuperate your capital. That's what it means on paper. But if I inverse it, it means the EY is 5%. So you can compare this 5%, with your FD, say 3 to 4% now. So is 5% attractive enough for us to start investing into this stock? On the other hand, say we have another stock, also $1, 1 ringgit price today, but the earnings per share is 10 cents. So using the same formula, the earnings yield is 10%. Now in this case, it is much easier for us to decide, because 10% is about 2.5 to 3 times more than our FD rate. So it makes investment sense for us to put our money in this stock. But of course, this is just one angle. Investment is not as simple as step 1, 2, and 3. Now that is on the stock level. What about when we have a collection of stocks in the portfolio? Can we find what is the average PE or the earnings yield of the portfolio? And turns out that we can. So now I know this formula can be quite intimidating, but trust me, it's basically very simple. All right, it's basically a summation of the individual stocks EY, all right, multiplied by the weightage of their portfolio. Okay, then you sum it out together. That will gives us the average portfolio EY weighted on the portfolio contribution to the. Now, for example, if you have only one stock, all right, then the portfolio EY will be based on the EY of that stock. If you have 2 stocks and each they are equally distributed, meaning 50% in stock A, 50% in stock B, then the portfolio EY will be the average of these two portfolio, these are stocks EY. All right, so simple as that. So you can just extend your understanding to 3 stocks, 4 stocks, up to N stocks. Okay, so that's basically what the formula means. It's very simple. All right, just don't be intimidated by the formula. So let's give an example. Now, this is again based on our model portfolio, which I shared in the previous webinar, slide 14. This is exactly lock, stock, and barrel from the slide. So again, to recap, there are 6 stocks here from AirAsia, TunePro, TM, UGTech, Getronic, and Elsoft. By the way, please remember our disclaimer. This is not a stock pick.
Yeah, doesn't mean you should buy AirAsia or Getronic, okay?
So if you can, they can see this screen, right?
Can.
Yeah. So if you focus on this, it's very clear that the way we plan the allocation for this portfolio, we have the highest allocation of 25% on AirAsia. Okay, and then the second highest is 20% with UGTech, and then followed by Getronic and Elsoft at 15% each, and TunePro and TM at 15 and 10%. Okay, so based on this, we already know that there are certain stocks in this portfolio that have a higher importance or higher weightage on the overall portfolio parameters, right? Now, so the EY for AirAsia at that price point, $2.91, as well as the earnings per share, then the EY is 16.7%. But because AirAsia contributes 25% weightage on this portfolio, so if we multiply the allocation and the EY, right, so we get 4.2%. You get it? Okay, so using the same understanding, if you look at the second one, Tune Pro, the EY is about 10.9% at the time, and we allocate 15%. So the effective weighted EY is 1.6%. And if we do this for the rest of the stocks, we arrive at a average weighted EY of 9.5% for this portfolio. Now, if we inverse it, so you invest 1 over 9.5%, it will give you a PE of 10.5 times. So you have to ask yourself, right? I'm having a portfolio now, right? Is 9.5%, which is close to 10%, is this on your portfolio objective, right? Is this the right portfolio for me? Now, if you find yourself, if you do this exercise, right, I highly encourage all our listeners and our viewers to do this exercise on their own after this webinar. Find out what is your latest stock holdings, right, based on the market price, and do this exercise and find out what is your portfolio weighted EY or PE. Now, you may be surprised that your portfolio EY may be less than 2 or 3%, which means that you are actually going for quite high risk stocks.
Expensive stock.
Yeah, in a way, yes. Okay, so, or it could be also that maybe you're not taking enough risk as a portfolio. Remember, we talked about stocks that you're maybe not choosing stocks that may not be able to meet your investment objective. Here is on a portfolio level.
So why do we need to find the portfolio PE? Because if you find individual stock PE, we are actually ascertaining what is the valuation. Right? Is it highly valued or is it lowly valued? But how about portfolio PE?
Because you see, when we invest stocks, you're basically investing in a basket of companies.
Yeah.
Right. Now you have to choose the companies that reflect your investment objectives. Now, 10% may be enough for me, but for a youngster who are looking for high growth, right? Maybe this is too conservative. Maybe they want to structure a portfolio in a way that maybe arriving at perhaps 5-6% earnings yield, which translate to maybe 20 times PE. All right. So again, as I mentioned, portfolio timing is really about aligning your investment objectives with the kind of stocks that you choose, and as well as the structure of a portfolio. Now, in this portfolio, if I were to say I'm going to put 50% to AirAsia, all right, then it will definitely lift the EY of this portfolio, because AirAsia right now has the highest EY in this portfolio, which is 16.7% at that point in time. Okay, now using the same mindset, we can extend this idea to DY as well, because now PE is earnings of contributed by the company, but dividend is the money that we collect in our hands in our portfolio. So dividend yield is a better gauge of how much money we can expect flowing into our investment portfolio based on the historical trend. Okay. Now again, the definition of DY is stock price. Sorry, it should be the other way.
Dividend per share.
So I think I need to change this. Yeah. So bear in mind, dividend yield is dividends per share divided by stock price multiplied by 100%. Sorry about that mistake. Now, again, let's do some very simple example. If a stock price is priced today at one ringgit, and based on the previous annual dividends per share, this company gives 5 cents dividends. So the dividend yield today, based on the 1 ringgit price, would be 5%. On the other hand, if the stock price priced at 1 ringgit today but gives 10 cents, all right, we see the dividend yield is 10%. Again, typo, right? Now, using the same analogy, how we look at the portfolio DY is basically the same formula and the same logic.
Just the dividend yield times the allocation.
Correct. So let's go back to our allocation plan for this portfolio, right? So again, with AirAsia 25%, and the second UG at 20%. Now, AirAsia on the 15th of January 2019, when we were planning the allocation of this portfolio, the dividend yield at the price of 2 ringgit 91 cents is 4.1%. Okay. Now, if you scan through the list,
that is from the ordinary profit and not from
the dividend that the company paid.
Exclude the special dividend,
This one, no, this one includes a special dividend.
Includes special dividend.
Yes. So I've got a caveat later, which I'm going to share.
Okay.
Okay. So if you want to be really detailed, you've got to we call it sanitize the parameters by taking away the special dividends. Because unless the companies is in the habit of giving special dividends every year, and we have that kind of company. For example, Getronic. Do you know that Getronic gives special dividends every single year? Yeah. So because they got a very huge retained earnings base, so they can afford to give special dividends.
Cash reserve.
You're right. You're right. But so in this allocation now, I give you 10 seconds to go through this. Can you tell me? Can you find out what is the stock that gives the highest dividend yield at that point in time? It's in the middle, right? Telecom Malaysia.
You can type in the group, in the chat group, but
yeah. All right. So Telecom Malaysia at the point in time, at the price of 2 ringgit 58 cents, the dividend yield was 8.3%. Can you imagine? 8.3% is basically 2 times what I put in my FD, you know. And this is excluding the potential capital gain. Okay. So again, using the same understanding, I'm going to take the allocation of each stock multiplied by the dividend at the time to arrive at the weighted dividend yield. So if you do this exercise, the total portfolio, the weighted dividend yield will be about 5%. Now, I think this is a very good, it's a well-constructed portfolio because it gives a quite high dividend yield. All right. Now, of course, there's a lot of assumptions built into this because now companies may pay more or less dividend this year.
Based on their
so
profit.
This is assuming this status quo, meaning whatever the stock paid the previous year, is going to do the same this year. And that depends very much on how the business will perform this current year. Okay, so assuming 100%, this is assuming I deploy all the allocations in one go, there's no trading. All right, now if my CAGR target is 15% per annum, all right, and 5% I can get from dividend already, which means in order for me to meet my annual CAGR target, I just need to make sure that I can achieve a capital gain of 10%, and that's how it works. Now, if you happen, again, I encourage our viewers and listeners to do this on their own portfolio. If you find that your portfolio weighted dividend yield is 3%, so assuming that your CAGR is 15% on the long term, means you have to fill in the gap for about 13% capital gain. Now, if you have a very high dividend yield for a portfolio, say 10%, then you're not pressured to perform on the capital gain side. So that's how we look at things. Okay. Actually, there are many ways for us to calculate a portfolio PE or EY. You can Google it, how to calculate portfolio PE. For us, we use the Morningstar definition, whereby if you go to the web page, the link is at the bottom of this slide. Morningstar defines the PE ratio of a fund or portfolio as the weighted average of the price earnings ratios of the stocks in the fund's portfolio. So basically, that's what we went through just now. Okay, so by extension, we do the same for DY as well. Now, there are certain caveats that we need to be careful here. We call the outliers, because the outliers will skew the average weighted yields and makes these ratios meaningless. Okay, now for example, when you have a stock with very high PE, okay, or very high DY, as I mentioned just now, due to special dividends, right? You've got to be careful. So sometimes you may need to clean your data to exclude these stocks when you calculate your weighted yields. Now, stocks that is not profitable, meaning they have net loss, should be assigned EY of 0. Likewise, stocks that do not pay dividend should be assigned DY 0. Now, why this is important? Because remember, the EY is the inverse of PE, right? So sometimes when your stock has a very high PE, say 50 times or 80 times or 100 times, right, it will render your portfolio weighted PE meaningless. Okay, so in that sense, normally we encourage you to take out that stock, all right, when you calculate your portfolio P, unless that stock has a very high weightage on your portfolio. But again, as value investors, right, we normally do not encourage our students to put too much weightage on stocks with very high PE, because normally very high PE means there's a lot of growth built into it. All right. Otherwise, it's quite risky in this case. Again, when we talk about yields, it's not just earnings yield, it's not just dividend yield. We can modify the steps by using operating or free cash flow yields, but that will be even more stringent. Now, I personally prefer to use operating cash flow yield because it shows me the strength of the business in generating cash flow from operations, not just the net profit. As I shared in my previous webinars, right, we don't really focus on the net profit because net profit is not a pure cash item. It includes depreciation, amortization, the accounting figures like impairments, which are not real cash. So we prefer to look at the real cash parameters like the operating or the free cash flows. Okay. Now, how can we utilize or apply this portfolio P, EY, or DY? Now, it is very useful when we want to match our risk profile during the portfolio allocation stage. Say I'm a very conservative investor. I don't like to take too much risk, so I prefer my portfolio EY to be in a range of 8%, 10% or above. Okay. Again, I prefer that all my stocks pay dividends. So personally, I normally construct portfolios that at least has a dividend yield of 4% above, because you never know the stock price fluctuates, but dividends is the one that's coming into our portfolio. Okay. So that's the portfolio PE, EY, or the DY is more useful during the allocation stage, as I gone through the steps just now. But when it comes to rebalancing, it's a bit challenging to use these steps because when you want to rebalance, you need to make sure you have to update a lot of parameters. For example, say 1 year after you started your portfolio, right? The earnings per share will change, the dividends per share will change. So you got to update these parameters then to make sense of what is the current status, right? And again, in the allocation stage, we assume 100% cash deployment because we allocate 100%. But in a real sense, when we invest, we may not fully utilize our cash. For example, if you started with 100,000, I may not fully use the 100,000, I may use 60% or like 60,000 or 75,000. So I've got that balanced cash. And this balanced cash, how do I calculate the yield? All right. Some people say, well, it's not entirely true because
the stockbroker will still give you interest.
Correct. The stockbroker will give you interest, but then the interest is not fixed or it's not consistent every month. And different brokers will give you different interest rates. So this part is a bit challenging. So I normally do not encourage portfolio rebalancing using the portfolio EY or DY. So we've got other tools for that, which is even more interesting than this. Okay. So if you've got any questions, please type your questions on the Q&A
in the chat group,
yeah.
And then David will address them during the question and answer sessions.
Okay, great. So so this is basically an overall picture of how we look at the model portfolio that we shared in the previous webinar. So this portfolio is based on 100,000 capital, 100,000 ringgit capital. The weighted EY is about 9.5%, which translates to a PE of 10.5 times and a DY of 5.1%. Okay. Now, so as I mentioned just now, this is not really useful when it comes to rebalancing. So what other things that we can use for rebalancing? Now, if I were to take you a step back, EY and DY, these two figures, they are not entirely stock price, right? Because remember, if you remember the formula, the EY will have earnings per share, which is coming from the net profit, which is derived from the profit and loss account. dividends, the dividend yield has the element of dividends per share, which is a subset of the net profit, because dividends are paid from net profit. So again, which means this is a hybrid timing. It has an element of the price and element of the business. All right. Now, is there any timing elements that only purely look at the price? There are. Okay. So this is where we talk about the volatility range. Now, for that, we normally look at what is the 52-week low and 52-week high and compare that with the current price in order for us to gauge, what is the pure timing risk for the stock. Okay, so now moving on, so I'm going to talk about the 52-week volatility indicator. There are going to be two parts. The first part will be how we utilize this during the allocation stage. The second part will be how do we use this during the portfolio rebalancing stage. Okay, now again, let's start with a very simple definition, right? Now we know, all right, whether you like it, you love it, or you hate it, right? Stock prices are volatile in nature.
That's why people like stock market.
Yes, but some people fear it. They say, yeah, a lot of people, a lot of people that I know, when they buy the stock price stock today, right? What do they expect? The stock price must go up, right?
Yeah.
If it comes down, something must be wrong. Or they are, the fear will grip them. But as value investors, we love volatility because it creates the trading opportunities for us to reduce our costs if you do it right. Okay. Now, let's dissect the 52-week volatility. What does it mean, right? Okay. Let's first look at what is the meaning of 52-week. Now, the 52-week is basically a window of a 12-month period. And this, why is 12 months? It's not a calendar period, it's a 12-month period, meaning it is moving. So for example, if the current date is 25th of October 2019, then the 52-week window will start 1 year ago, 12 months ago, which is 24th of October 2018 until the end at 25th of October 2019. Now today, the date is 5th of November, right? So it means that today, if today is my end point, the starting point will be, say, 6th of November 2018. And tomorrow there'll be another, the window will shift. And this is important because as the window shifts, the range may change. Okay, as I'll show later. Now, volatility range is defined as the boundaries of the stock price, all right, in that 52-week window, the highest point and the lowest point, all right, and we're going to compare that the current stock price with that volatility range. Okay, again, as you know, this is the formula. Don't worry about it. It's there for you as a reference for you if you want to know, if you want to calculate your own in your spreadsheet. So I'm going to leave this for now. I'm going to skip to the visual because it's easier for me to explain this, right? So I recap. The 52-week range is the rolling 12-month window, all right, from today and the 1 year, exactly 12 months ago. And the price range is the maximum, the highest price in that range, as well as the lowest price in that 52-week range. Now, in this example, we have the stock price was going up and down in the past 12 months. All right, it reached a highest peak of 1 ringgit 20 cents, and it also reached a bottom at 60 cents some point in that 52-week range. Now, if the stock price today is $1, so how do you make sense of this? Okay, how do you make sense how much it has risen from the 52-week low at the price today, right? We use a formula. So we take the current price of 1 ringgit, take away minus the lowest price at 60 cents, all right? Then divide the whole thing divide by the range, which is the difference between 120 and 60 cents. So we arrive at 67%. Now what this means is the stock price at $1 today has risen 67% from the volatility range. Okay, all right. Now, if I come back to the slides, on the bottom, this is a moving indicator with limits. The limit is it has a maximum of 100% and a minimum of 0%. Now, what does this mean? Now, let's go back to the chart. So
the lower the percentage, the higher is the yield.
No, the lower the percentage, meaning it's closer to the low.
52-week low.
Yes.
So in other words, if you buy a 52-week low, your yield will be higher.
The range, the indicator will be 0%.
Yeah.
Now, for example, if the stock price today is 120, so if you fit in 120 to the formula, it'll be 100%.
Yeah.
So can it go more than 100%?
Cannot.
Because now imagine tomorrow, remember tomorrow there'll be a new range.
Yeah.
So say tomorrow the stock price goes up to 1 ringgit 25 cents.
So the 52-week high will be 1 ringgit.
Correct. There will be a new 52-week high at 125. So it will still be 100%. Now conversely, on the other hand, right? If the stock price based on the same range as now is today is 80 cents. All right. So from 60 cents to 80 cents, the range is about 33%. Okay. So actually from here we can already know. Now this is purely based on pure timing risk. All right. Now between A 67% and B 33%, which gives us a perceived lower timing risk.
33%.
33%, right? Now what it means is, yes, the price now is still above the 52-week low, but the difference is 33%. Okay, now that does not mean that the price will not go to 0%. Don't forget, the price 80 cents tomorrow or the week after or the month after can drop to 60 cents. And by that time, meaning the volatility indicator will be 0%. Now, what happens if the next day the stock price went down to 55 cents? It will be 0% as well. Okay, but overall, basically what it's trying to say is, because when you construct a portfolio, we need to have a sense of how much has each stock risen based on the 52-week range. Okay. I'm gonna pull back all this picture into a portfolio later. This is on the individual stock level.
Individual stock, right?
Yeah. Okay. So applications, the 52-week volatility indicator measures how much the stock price has risen from the lowest price, as you mentioned before. The higher the indicator implies, the word is implied, doesn't necessarily mean, but it implies a higher timing risk, whereas a low 52-week volatility indicator implies a lower timing risk. Okay, so visually we can look at this. So imagine you have a portfolio. So in this case, there are two stocks in the portfolio, stock 1 and stock 2. On the left is the green bar is a 52-week low, and the red bar represents 52-week high. So stock 1 has a volatility range of indicator of 31%, whereas stock 2 has indicator of 92%. So based on this, straight away we know, all right, you can visualize already which stock is nearer to the 52-week high. It's stock 2, right? Because it's risen 92%. But that does not mean that there is no chance for the stock to go out even further. All right.
Maybe the stock has more momentum because it's on the
rising
trend.
Or there is a huge, how to say, a larger magnitude for the stock to drop in case something goes wrong. Whereas on the stock 1, the magnitude is smaller. Remember, the essence of portfolio is to minimize our risk, not to maximize our return. So how we can apply this? Very simple. Now, if say I only look at 2 stocks in this portfolio, now I'm not going to put 50% for each portfolio based on this volatility indicator. For me, because I'm a risk averse or I'm more conservative, I may want to put more allocation into stock 1. Because the stock price has not risen as much as stock 2. I may do say 60% or 70% on stock 1 and the balance for stock 2. All right. Now this is one of the ways we can apply the volatility indicator when we do portfolio allocation. Okay. Now unlike the portfolio PE and the DY indicators, this indicator is more versatile, but we've got to take note that this is based on a pure timing risk, meaning it does not take it. I do not care about earnings per share. I do not care about dividends. All right, there is no element of the business in this in this scenario here. Okay, but they are best used. The 52-week volatility indicator is best used not only during the allocation stage, but especially for the rebalancing purposes. Now, for example, over some time, you manage your portfolio well, some stocks will go up, some stocks will come down, right? So we can use this to rebalance our portfolio. in a way, I can sell stocks that are going up in their timing risk and deploy it to stock that has a perceived lower timing risk. Okay, so that's one of the ways. I can also optimize my stock weightages based on this indicator as well. All right, so let's go through some example. Now again, this is an extension of our previous portfolio allocation plan. So if you look at on the right hand side, so this is something new. We have the 52-week volatility range indicator. Now you can see straight away, right? Among these 6 stocks, right? AirAsia has risen the most based on its individual volatility range, meaning it has risen about 43% from its 52-week low. Now, on the other hand, on the other end of the spectrum, if you look at stock like TunePro or even Getronic, these stocks are still near the 52-week low, which means that compare Getronics, for example, at indicator range, at the range indicator of 3%, you compare that with AirAsia 43%. So it implies that Getronic has a lower timing risk than AirAsia in this scenario. Okay, now so how can I utilize this, to optimize or to better allocate my portfolio? So I give
okay, like for example, I just want to highlight a special incident because AirAsia has been a very interesting example with the DY, EY, and volatility range, because now AirAsia, because of distributed many rounds of a special dividend, the stock price will adjust down to the 190.
Correct.
So by just looking at a 52-week volatility range, we would think that it is of lower risk.
Yeah. So again, as I
so we have
highlighted
to
just
take out
now,
all the abnormalities.
of course. Now the 52-week range indicator is a pure timing risk. I do not care. It means it discounts, or it does not. It eliminates all the qualitative elements of the stock. Now remember, investing is, if you followed through my webinars, we focus more on qualitative. All right, the story or the qualitative aspect will drive the numbers, not the other way around. So this is purely in looking in silo, looking at very specific only
quantitative
on the quantitative timing indicators, but we always need to have in mind what is the qualitative aspects behind. Okay, now if we simplify, looking only at the timing risk factors, and we forget about all the qualitative aspect, right? Now what I can do in this portfolio is very simple. Now, remember, if you look at this again to recap, originally AirAsia had 25% allocation. Okay, now because among the 6 stocks, AirAsia has the highest perceived timing risk at 43% indicator range indicator. I can do something like, hey, instead of putting 25% into AirAsia, I can say take up 10%, meaning I only allocate 15% of my capital to buy AirAsia. Then the 10% I can shift it, or I can use it for stocks that has a perceived lower timing risk. For example, Telecom Malaysia. Originally, Telecom Malaysia, I intended to do 10% allocation only. But look at this Telecom Malaysia, EY close to 10%, DY 8%. It's a steal, right? Okay, and then the timing risk is only 11% above its lowest price based on the volatility range. So in terms of timing risk, it does seem that TM is more attractive than AirAsia at the time. Okay, so an idea could be I take 10% out for AirAsia allocation and put it into TM. So TM will grow from 10% plus and 10% to 20%. Same likewise.
So some rebalancing.
You're not rebalancing, but modifying or optimizing your allocation. Remember, this is during the allocation stage. So before you start your portfolio. UG-Tech, using the same analogy, UG-Tech instead of 20%, I may want to take out 5% from UG-Tech and put it into a stock like Getronic. Why? Because Getronic has fairly attractive dividend EY earnings yield and dividend yield compared to UG-Tech, but the 52-week volatility indicator is much lower than UG-Tech. So this is how I can utilize the 52-week volatility indicator during the initial allocation stage. Okay, all right. So I'm going to, I think I have some examples later. Yeah. So this 52-week range is not used only for the allocation, but it can be used especially during the rebalancing as well. Okay, so this I just give you a very simple example of how we can utilize the timing to optimize our allocation during the initial stage. All right. Now, moving forward, I'm going to talk a little bit about how do we rebalance our portfolio using the 52-week indicator, right? So, so this is the portfolio which is started on the 15th of January 2019. Okay, so about 1 month later, what we saw was, because the stock price changed, right? Now you see on the front of you just at the end of the month, the stock price moved, and then the 52-week volatility profile changed as well. Okay, now barely 2 or 3 weeks, the portfolio is already making money. So I think we were quite lucky. We started this portfolio when the market is near the bottom. But along the way, as you can see, all right, we started trading. Okay, as you can see, if you can see in front of you, on the left hand side, look at Asia. Now, if you look at the dates, if you focus on the dates, right, sometime in January up to May, we actually push our allocation for Asia to 30%. Okay, and if you look closely, actually we were buying more when the Asia price came down. So we bought at 280, 1,000 shares, so we call it the marker. All right. Then at 270, when it went down about 10 cents, we accumulated 4,000 more shares, so we got 5,000. Then it went down further to 260, right? Then we accumulated another 4,000 shares, so on and so forth. Now, as the share price went up, we started to sell. Okay, so this is how we deal with the timing as well. All right, because AHA at that time, remember when we do the allocation, AHA has the highest earnings yield. So as the share price comes down, the yield increase even further. So it makes it a very attractive investment thesis for us to allocate more money into this stock. Likewise, on the right hand side, we have TunePro. Okay, using the same logic, we were trading TunePro quite aggressively as well. Now, as you can see, 5 months after we initiated our portfolio, on the 21st of June, the portfolio was making money. AHA was already making a profit of 1,500 ringgit, whereas TunePro was already making down again almost the same 1,500 ringgit, so on and so forth. Okay, but interestingly, now you look at TunePro. When we started TunePro, the 52-week timing is at near the low. All right, but on the 21st of June, TunePro, the 52-week volatility is about 33%. So the share price has gone up. So we started to take profit as well. So on the 21st of June, our weightage is about 10%. Now, as the share price will move out, we will take more profits again. So this is how we do the timing. Okay. Now, if I look at what is the latest, so this now is already 5th of November. So this is our status on the 21st of October. We have bought and sold some stocks. We have completely sold off TunePro because of qualitative reason, not because of timing issues, because we do see some structural risk in the business. So we make some money, we sell off everything. Okay, and we use the money and we bought new stocks, for example, like Inari and Pentamaster, which is originally not in our portfolio before. Okay, so now on a consolidated basis, this is the profile of the stocks that has made or lost money in this portfolio. So luckily, on the 21st of October, all the stocks has been making profits for this portfolio. Now, as you can see here, the stocks, the blue color represents the amount of capital that is still invested in this portfolio. So as very easily, we can see that we still have a lot of weightage in Asia, which consists about 25% at that point in time. The second highest weightage is UGTech, all right, at 14.4%, so on and so forth. But the stock that contributed the highest profit for us is actually the one with the biggest green bar, which is Inari. At that point in time, Inari contributed a profit of about 5,979 ringgit for this portfolio, followed by Gtronic, 3,241. So how do we achieve this? is basically through the trading, the active trading. Now remember, value investors does not necessarily mean that we buy a whole. You can do that, but for us, we trade quite actively because our objective is to reduce our balance cost. Remember, again, if you look at this, on the status on 21st of October, focus on Inari. Now, Inari right now, the portfolio weightage is about 5.3% at the point in time. But what's the ABC? What's the average balance cost of Inari, which is highlighted as a gray?
Yeah, how can it be so low?
It's almost close to zero,
yeah,
right?
But what I understand from your what you say just now is that you just recently got into Inari.
Correct.
And the average balance cost has lowered down to 1.7 cent in such a short period. How do you do that?
Basically, we front load. So remember, again, like even like let me see, in this Asia case, right? So when we in a very short span in time, we spend 30% of our allocation onto this stock, and then as the stock price goes up, right, we start to sell. Now, not again, like I mentioned, not all stocks. Now the stocks behave the same way. So we got lucky with Inari because Inari we bought it near the bottom, all right, and then we spent quite a huge allocation on Inari, about 30% as well. And as the share price goes up, and for Inari the share price goes up quite drastically. I think the lowest price was about 170 or something, or 160. I can't remember. Then as it goes up to $2, we start to sell.
Okay.
All right. Now, of course, if I can sell just enough for me to reach zero ABC, but I don't need to do that because to me, 1.7 cents is close to free for me as well. Okay. Now the beauty of this is, suppose now Inari is going to come out with their next quarter result, right? Okay. So suppose, I mean, just hypothetically, if Inari were to report a less than favorable result for the Q3, right? And then the market suddenly realize, oh, there's there may be something wrong with the Inari or something like that. So they start to sell down, and the share price go down from $2 to 190 to 180. Now I love it, because you see this portfolio at that point in time has 38% cash. I can deploy this cash to buy back Inari shares. So even if I buy back, if I don't buy too much, my average cost per share will still be very low. Okay, at this point in time, the reason why we sold down Inari is because if you look at the 52-week volatility range, it is near the 100% limit, right? It's 91%. You notice that? Now you notice that most of the stocks that has a higher 52-week volatility indicator has quite low weightages in this portfolio. Meaning we already took profit because the share price has went up. All right.
Yeah, but for stocks that fall into category of growth stock, they will likely to be in the high side of the 52-week range.
Yeah. As the share price move, it may.
Yeah.
And it hit 100%, it may move higher.
Yeah.
But again, I want to highlight again, the purpose for portfolio management is not to maximize our return, but to minimize our risk. So we already make a substantial amount of money in this portfolio for that stock, so it makes sense for us to take money off the table. All right. Now the stock price may move further even more. All right, which means that but the most important thing is I don't lose money. I may end up making less money than if theoretically I were to sell it at the high side on the peak, but that is not my objective. My objective is to make sure that I have a consistent portfolio performance based on my risk profile, and that is what this is for. Okay, so again, there's no right and wrong here. You may say, hey David, Inari or Tronic or even this Pentamaster, right? It is near the 100% 52-week volatility. It may go higher. I totally agree with you. All right. If it go higher, good. But the only problem is I have less stocks on my hand now. But it's fine because I already made money. Okay, and I can utilize the capital in other stocks. Okay. Now I've got a couple of minutes left. So Turn off webcam.
Okay.
I've got a couple of minutes left, so I'm going to talk a little bit about how we rebalance our portfolio based on the cash balance. Now, again, I showed this before. This is the long-term evolution of this portfolio performance since inception. Now, as you can see on the week 0, that is when we started the portfolio. The cash balance is 100%. So you look at the scale on the left, it's 100%, meaning the blue bar is on the 100%, meaning I've got 0 stocks. Along the weeks, as we move on, we started to use the cash to buy the stocks, and then we trade, we buy and sell, and it will affect the level of the cash. Now, on the right-hand side, on the orange scale, it reflects the portfolio return at that week. So as you can see, the portfolio goes up and down along the time, right? But what is my barometer? My GPS? My GPS is the green dotted line, which represents my 15% CAGR target. Now, this is very important because it will dictate what I do with my portfolio when it comes to whether I should sell or I should buy on the portfolio level, not on the stock level. Now, if I can just bring your attention to the middle part, which I highlighted here now. Now, as you can see, on the highlighted red zone, the portfolio performance is above my intended 15% CAGR target, right? So, Chunxian, if this is your portfolio, right, at that point, you know you reach your target already. At that point in time, what should be, logically speaking, should you be buying more or should you be taking profits?
If I want to be conservative to meet the portfolio return, then
it has already met your.
It
is above your intended target already. So it makes sense for us to cash out, net sell, the net buy, right? So if you look at the bars I highlighted, the bar is also trending higher, meaning my cash balance is trending higher. So this means that my net action was selling. I was net selling this portfolio. Now, it doesn't mean that I'm selling all the stocks in the portfolio. I could be buying some stocks, I could be selling some stocks as well. But the net effect is I'm net selling, so my cash balance will build up. You see that? All right. Now, on the other hand, if you focus on this green area now, for whatever reason, I think that time the US-China trade war again intensified, so the market got jittery. Then whether you're holding good or bad stocks, all the stocks price came down, right? So it affected our portfolio performance. From 12% return, it dropped to 4 to 5% in a couple of weeks' time. So you see, what was net action? The cash balance went from 50% down to 30%, down to 25%, down to 15%, down to 10%. So that indicates that I was net buying in this portfolio. Why? Because the share price has come down. When share price comes down, assuming there's nothing wrong with the business, it used to go up. The 52-week volatility range indicator will come down, which implies lower timing risk. So it makes sense for me to deploy more cash into the market to average down my costs. All right. Now, as the portfolio picks up again after that, you see what happened to the cash balance on the right hand side. The cash balance starts to pick up again. Correct. I was net selling because the portfolio again has went up to my intended target. So this is another way for us to do portfolio rebalancing on a high level like this. Okay. They are not just on the stock level. This is I constantly take care of this part because I learned my lesson. Back in 2017, it was a great year for tech stocks. All right, a lot of our portfolios went up more than 30% in 1 year.
And then you did not sell.
So naturally, we felt like wow, you're so good in the stock market, right? Now, what we forgot was because our portfolio has overachieved our intended target. So by right, we should be net selling to conserve our cash, to reduce the timing risk, right? But because at that point in time, everyone was talking, the 2018 will be a great year, there will be a fantastic growth. We also believe that, we maintain our weightages. We are close to fully invested, about 90% invested. Then what happened in 2018? Trade war happened, boom, 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 all came down. So we learned our lesson from that, and that's why we built this system to make sure that we do not become too greedy. Yeah, again, I want to reiterate here, portfolio management is not about maximizing your profits, but to minimize or to manage your risk. Okay, and this is one of the ways that we do it.
What's the difference between the dotted line and the non-dotted line?
You mean the
green,
orange line, the green line?
Yeah.
Basically, the orange line is the linear average, whereas the green line is my KGA target. Yeah, it's basically there just for engineers. We love
okay,
lines.
okay.
Yeah, but my GPS is always my KGA target. So if your KGA target is 20%, naturally your slope will be higher, steeper than mine. So maybe your some others with low risk profile, their KGA target may be lower. All right. Okay. So if you do a recap of what we went through tonight, the topic can be quite technical for some.
Yeah.
All right. But basically, portfolio timing, we split to two groups. One is for during the allocation, and the other is during the allocation and rebalancing. All right. We talk about portfolio PE or EY and the DY when how we can use this to better optimize our portfolio allocation during the initial stage. Then we can also utilize the pure timing risk, which is the 52-week volatility indicator, all right, to enhance our allocation in the initial stage, as well as for rebalancing purposes. Now, other than that, we can use cash balance, your investment targets, your risk tolerance, and many more indicators to actually take care of your portfolio timing. Now, the most important thing here is, we invest for the long term. And the great thing about this is because stock price move up and down every single day, right? It gives us all these things as a whole gives us the opportunities to rebalance our portfolio. All right. Now, right now, tech stocks has went up quite a fair bit. All right, and we have been taking a lot of profits from tech stocks, and we are looking to rebalance these the profits that we have sold, to other stocks, perhaps like Asia or other non-tech stocks right now. So this is the beauty of investment. Every day is a great day to invest. Okay, so I think thank you very much for listening. I hope it's not too technical. We can move on to the Q&A session if you have. But before we go for Q&A, if you enjoy this session, we have an upcoming meetup session with our students and graduates on the 23rd of November, happening on Armada. If you want to find more information, you can go to our Facebook at FIX Press MY, all right, to find out more. Thank you very much. So do we have any questions?
Okay, so if you have any question to ask David today, please write in the question box. We will ask him as many questions as we can. Now, the first question I have on my screen is that, let me see. Portfolio PE and the dividend yield are more meaningful for selection from multiple portfolios. Is retail investors recommended to have multiple portfolios?
No, actually, just now all the case studies is based on one single portfolio.
One single portfolio.
Because one single portfolio may have multiple stocks. So if I were to paraphrase your question, if you have only one or two stocks that you are holding right now, or you intend to buy, so maybe you don't have to go through all these tedious steps to have a portfolio. But even more than that, right, it's highly recommended that you at least go through the proper steps to construct your portfolio. So I hope you answer your question, Edmund.
Okay. Now, can you explain a little bit about the stock categories that you label, such as mod growth,
okay, so
high growth, being assigned to the individual stock? Can you explain on that?
Okay, although this is not a portfolio timing related question, but I'm going to answer that as well. So I think you are referring to that is Mr. Zulkifli.
Yeah, correct.
Zulkifli, right? So yeah, I think you mentioned this, right? So depending, you don't have to follow this, but based on our SOP, our standard operating procedure, we normally have two categories of stock. The first category is the industry that they serve. Okay, and the second category is based on the Peter Lynch stock category. All right, now why this is important, Mr. Zulkifli, I will recommend you to go back to the essence of portfolio management. I think it was 2 webinars ago. Download the slides. I have explained in detail why the category is important, because it is an indication of the business risk. AirAsia is a high growth stock, TunePro is a turnaround, TMC to be a turnaround, so on and so forth. And each category will imply different business risk.
Okay, so the next one, when you calculate portfolio yield, are we supposed to use the average balance cost price instead of the stock price at the point of time?
No, when it comes to yield, we always remember, I cannot stress this enough, we always use the market price. Do not ever use your average balance cost. Simply because of the idea of opportunity cost. Now you may say, hey, by right, my risk is based on my average balance cost, right? Not on the market price, ma. But let me give you an example. So the question is by Mr. Edmund, is it?
David.
Oh, David as well. So let me give you an example, David. Now say that you bought a house, a property, an apartment, small apartment, say 10 years ago, and you bought it for 300,000 ringgit. All right. And the and let's say, just for simplicity's sake, you are getting 30,000 rental a year. Now, David, how much yield are you getting from your rent based on year one? So you take 30,000 annual rental divided by the market price at that time, which is 300,000. So yield is 10%, right? Fantastic. Now, say 10 years later, say, just assume that your rental is still the same, 30,000, but your property price has gone up to 1 million. Now, my question is this: is your rental yield still 10%, or has it gone down? All right. Now, my question is, in other words, do you calculate your rental yield based on the market price of your property, or your cost of holding? Now, don't forget, if I use the market price, right, 30,000 divided by 1 million, all right, which is 3%. Now, what I can do is say, hey, 3% is not so much different from my FD rate, right? Theoretically, I can sell this property for 1 million and put this 1 million into an FD, which essentially is like a much lower risk than the property. So this should be your mindset when it comes to portfolio as well. Never ever use your average balance cost, but always use the market price when you calculate your yield. All right. In my example just now, in this example, we were using the price at that point in time on 15th of January to do the allocation. Okay. So of course, if you want to look at it today, then you need to use the market price today, not the average balance cost. So I hope you answer your question, David.
So the next question is, can we use earning yield and dividend yield to calculate REITs?
REITs, I think that's a very good question. You theoretically, there's nothing wrong to use these parameters when it comes to REITs, but practically, remember, REITs is not really a business per se. They are a trust that holds a group of properties that generates rental income, and then the management takes a certain cut, then they distribute the rest to the shareholders. So the risk is not really in business, or although on paper you can use the same when you want to gauge your timing risk. So there's nothing wrong if you want to use the EY and DOY aspect when you do REITs, but personally I won't be doing that.
Okay. Now, so next question is, why don't you allocate equal weightage to all your stock to minimize risk? How do you decide which stock get more weightage?
This is question.
If your biggest bet goes wrong?
Is Mr. Chong, right? This is a great question. Okay. Now, of course, although this is a very simple slide, but there are a lot of work put into it. Now, say if you don't really have time, Mr. Chong, like we do, to really dig deep into business stocks like AirAsia, TunePro, TM, UGT, right? But you like these stocks, you put it in portfolio. Yes, You can do an equal weightage. You can, for these 6 stocks, you can put like 16-70% across all your stocks. It makes sense. But because we do a lot in-depth analysis and we understand these businesses, so we normally enhance or we optimize our allocation plan based on what we understand the business. But you're absolutely right, Mr. Chong. What if, say, Asia, our investment thesis went wrong? All right, because of MFRS or something went wrong in the sky, the Asia price dropped, say, from 290 to, I think today is
let me check.
Today is I think 190, but of course that is after the 90-cent special dividend. But I mean, theoretically, if Asia was to drop 30% and I've got a weightage of 25%, right? Yes, you're absolutely right. It will hit my portfolio bottom line even more compared to an equal weightage. So again, it depends on your level of comfort and your understanding of the business. You can do an equal allocation, or you can do like what we do based on our understanding and the timing of the stock. I hope I answered your question, Mr. Chong.
Okay. So the next question is, let me see. Can we conclude that the lower percentage of the 52-week volatility is a good timing to buy a stock?
Again, so let me go through the slide again. So I think who's the question? Person who asked the question?
Mr. Chai.
Mr. Chai, right? Now I highlight here the 52-week volatility indicator, because it is a pure timing risk. So all it does at best is imply a higher or lower timing risk. Now don't forget, because the maximum limit is 100% and the minimum limit is 0%. But the problem is it is a moving window. So each time we have a new date, we have a new week, we have a new month, right? The price range may differ, so it may change the volatility range indicator like that as well. So it is not a hard and fast absolute indicator to gauge your timing risk, but it is a good proxy or good implication of whether it is near the high or low timing risk based on the 52-week range volatility.
Okay.
So in other words, try not to use this as your single indicator. Never ever use one single indicator to decide on your investment decision.
Yeah. Right. How you do your investment decision is mainly qualitative as a basis.
Yes.
After that, you do trading based on the timing risk, based on the EY.
Yes.
Yeah.
So although here we talk about portfolio timing, but there's a lot of work done behind the scene to understand the qualitative aspect of these stocks as well.
So you really need to put in a lot of effort to do a lot of homework to understand the industry.
Well, investment is simple, but it's not. I mean, it's never easy. You have to put in a lot of work. Nothing good ever comes easy.
Okay. Next question we have is that stock prices go up and down every single day. Now, how often do you do the portfolio rebalancing?
Good question. So this is a question by Mr. Ray. I like this question because I asked this a lot. Now, Ray, I'm not sure if Ray is a student or he's working already. It really, again, it depends on your own situation. Now, if you are a full-time employee or you have your own business, right, you cannot afford to watch the stock market every day, right? So you can rebalance. It depends on you. It depends on your free time and resources. You can do it every month, every week, every quarter, or every time. You can. In fact, nowadays with all these wonderful apps and fantastic technology, right? You can even set certain alerts to send to your email or your SMS when it hits certain range. Okay. But I would recommend at least to look at your portfolio once a month so that you don't get out of touch of your investments. Remember, this is your hard-earned money, right? So at least make some effort to at least look at the portfolio every month. But for people like me, like us, full-time investors, we track the prices every single day. Not to say that we want to look at the price, but because we use this thing called the GTD, good to day, whereby if I park to buy at $1, if it doesn't hit today, tomorrow the system will key in for me. Then if not, then the next day and so on and so forth. But generally every single week I will have a snapshot of my portfolio. That's how we are able to come up with charts like this, because we track our portfolio performance every single week, and we can afford to do this, or we have to do this because we are full-time investors. Our bread and butter depends on this. But again, depending on your own situation, you can do this based on your own resources and your own free time.
So the next question is, like, for non full-time investor, like I believe most of the people watching this right now are not full-time investor. I think we have a day-to-day job. Do you rely on some software to create this kind of chart and draw this kind of KGA line? That's one of the questions as well.
Okay, great question. There aren't many tools out there that gives us this kind of cool features.
Cool charts, cool graphics.
Well, I used to be an engineer, so engineer Excel, right? They're basically live and die Excel. But you can use free tools. There are many tools out there today, like the i3investor.com that I highlighted in my previous webinar. You can use this to track your portfolio performance. You can track your average balance cost for each stock. You can track your cash balance using that. It's free, all right? And there's no limit.
On i3, you mean?
On i3investor.com. I believe there are many other free tools as well, or even paid tools that are available today. But what you need to do is, depending again on your free time, you need to take a snapshot of your portfolio every week or every month or every quarter. Then you can construct something like this, which we have on the screen. Okay. If you ask me, Chun Sian, I want this on a daily basis. But of course, I don't have the tool yet because I have not developed the tool. So what we have is we have developed our own suite of Excel tools to generate this chart every single week, but not every day. Yep.
Okay. So the next question is, how do I rebalance my portfolio with respect to my portfolio's PE ratio? Because PE is compared with an industry average. So what is the PE I should be comparing to?
Yeah, I think this is a question by Jimmy. All right, Jimmy, I think this is a great question. But again, as I mentioned earlier, look at this slide. PE is, where is it? As I mentioned earlier, for rebalancing purposes, portfolio PE may not be the best. As you mentioned, right? PE changes, business prospect change, right? So it's a bit tough. Portfolio PE, we utilize it more for during the allocation stage, which is the initial stage, and not for rebalancing along the way. For rebalancing purposes, we normally rely on the pure timing risk, like the 52-week range. But Jimmy, let me give you an idea. What you can do is, perhaps you can set yourself a 1-year time frame. So let's say in 2019, right, you start with portfolio and this structure, right? You have allocation, this and that, and then along the way, in the whole year of 2019, you manage your portfolio well. You have a very a commendable return at the end of the year. Now, what Jimmy can do is, after 31st of December 2019, he can sit back and consolidate his portfolio and say, hey, 2020, what can I do to rebalance my portfolio? So maybe the tech stocks has run out. So next year I should look at other industry. I should focus not only on tech, but maybe on construction or on other industry, or palm oil, for example. Now palm oil very hot, right? So on the 1st of December 2020, you can rebalance your portfolio with a new structure. So at that time, Jimmy, you can utilize the portfolio, the PE and the DY angle again for that. But along the way, it will be very tough for us to use portfolio PE to rebalance. That's what I would like to say. So I hope I gave you an idea to consider, Jimmy.
Okay. So the next question is, should we do portfolio timing if our total portfolio amount is considered low, let's say below 10,000 ringgit?
I've got question by
Lanston Lee.
Lanston, so that's an interesting name. Lanston, let me give you an answer, and this is a very honest answer. It doesn't matter on your asset size, it matters on your number of stocks. Let me give you an example. I have one of my earlier portfolio is my brother's portfolio. I've got two brothers. my elder brother, he started with a portfolio of 80,000 ringgit. My younger brother, he put all his ang bao money and opened a Hong Leong Bank e-broking account. And guess what? His ang bao money is only 12,000 ringgit.
Okay.
12,000 ringgit. All right. And he had 3 stocks that time. All right. UGTech, Asia X, and I forgot another stock. I can't remember already. All right. 3 stocks. It already is enough for him to have a proper portfolio management system. So this portfolio, 12,000 ringgit, doubled in 3 years' time, 24,000 ringgit. Okay. So at 24,000, I said, hey, brother, I think you can take some money out to enjoy lah. So he took out 4,000 ringgit. All right, to enjoy. He bought a new phone, or he bought a new laptop. I can't remember. Then the remaining 20,000, we restart a new portfolio, and that is how we can do the reset. So I hope I answer your question, Mr. Lanston Lee.
Okay. All right. So the next question is, when it comes to trading, what is your advice on when to sell and when to buy back? Like just now you mentioned a couple of the portfolio rebalancings. So let's say the average cost is 1 ringgit. Do I sell some at 105 with the aim to buy back, say at 1.95 cents?
So if this is a question by Mr.
Tong.
Oh, Mr. Jason. Okay.
Jason.
So, all right, I'm going to answer your question based on the scenario that you just mentioned, right?
Yeah.
So your balance cost is $1 and you want to sell at 105. My question is this. For $1 to 105, that's 5%, right? So you have to got to ask yourself, is this 5% enough for you to take profit? It may be enough for you because you may have a very large allocation. Maybe say you have 50% or 30% of your portfolio into this stock. But generally, for us, we try to avoid trading at such a tight band. So I would prefer something more than 10 or even 20% before I start take profit. So based on your scenario, if my average balance cost would be 1 ringgit, I would prefer to take profit or start to trade above, say, 1.15, which 15% or 20%. Then I will buy back at, say, $1. Yeah, so I prefer to work on a wider range than such a tight range, because if you work on a tight range, right, means you have to be very precise on your timing. Yeah, and normally, you know, just to give you an idea, our investment thesis when you go into the stock is to double up. But we give ourselves 3 to 5 years for the stock to perform. But along the way, we will trade, but our trading band, it should be at least 15 to 20%. So below that, I mean, if you love to trade, right, you can do it. There's nothing wrong. But our preference is to trade the wider band.
So in other words, you're saying that if the average cost is 1 ringgit, you might consider to sell. Sell some at 120.
120 or 115.
115 and buy back at maybe 1 ringgit or even.
Buyback. The buyback, depending again.
The kind of circumstances.
Yeah, it could be 10% or 15-20% below the sell price.
Okay. Yeah. But what if after you sell at 120, it go up to 130? What do you do?
Chun-Sen, happen to us all the time.
Yeah. So what do you do? Do you chase at 130 or you wait?
So generally speaking, remember, we don't sell everything in one go, and we don't buy everything in one go, right? So let me give you an example. Harta Lega. Recently, we will buy a lot of Harta Lega.
No wonder the price go up lah.
No, it's not. Yeah, not that big. Simply because of the qualitative aspect, not the timing. Because Harta Lega previously, the previous quarter, they were hit quite badly. I think the previous few quarters because of they lost some market share. Now we look at the trend. You know, Nitra is coming back. In fact, the developed countries like US, Europe, right? The use of nitrile glove has expanded into non-medical industries like your security, airport security, your transport security, your industrial, your F&B. So the demand for nitrile is going up. And then there's a ban on latex as well. Now you look at US, they're banned already. Europe going to ban. Australia is going to ban. Taiwan is going to ban. So when you ban latex, naturally the demand will go to nitrile. So with this qualitative aspect, we decided, hey, I think it's time. Again, on the timing, we feel that Harta Lega is a good time. All right. So we got a lot at 510, 520. All right, recently. All right. Then the stock, no, I think it's 520, 520. Yeah, not 510. Then the stock price move up to
55.
55. Today was what, 56. I can't remember.
Yeah.
So
near 550
yeah,
range.
and we took one third. We took one third profits off the table. I remember. We took profit yesterday.
Wow. So you
560. 560. I think yesterday was more than 560, but we took profit out. We took off one third of our holdings at 560. So we got still two thirds. Now after today's, I think Hatta Relega announced good results today, which is a quite good quarter-on-quarter buy. So tomorrow the stock price may move out. I still got two thirds to sell. But if it comes down for whatever reason and my thesis is still long term and there's nothing wrong, I can buy back my one third, say 10% below my average sell price. So never ever buy everything in one go. Never ever sell everything in one go. Yeah. So I hope I answered that was your question, right?
No. That is just okay. That's my question.
Yeah. Okay. So the bottom line, don't buy everything in one go. Don't sell everything in one go.
All right. So next,
time for one more question.
Oh no, we have actually
exceeded.
We have reached about 10 o'clock. Okay, if this portfolio timing webinar has been beneficial to you, please key in the comment that it is helpful. Let us know. If it's beneficial to you, please type in the comment and say that it is helpful. Okay, let us know if this is okay.
Okay.
All right, so let me promote the next webinar, which is on the next webinar, which is happening next Tuesday. We'll be talking about technical analysis masterclass, but it is in the language of Chinese. So in Chinese, it's called 技术形态学堂. So on 12th November, next Tuesday, 8:30 to 10 o'clock, if you want to learn how to see chartings, please join our webinar. The registration link is already put in our chat group. Please head over there to register. Okay, for those of you who have been asking how to watch previous webinar by David, you can go to our YouTube channel to find our.
Is it on the Live Champ YouTube channel?
Or, yeah.
Oh, great! I still want to know.
Yeah, I guess that it's also available on Bursa Marketplace. Okay. Yeah, you can go to either sites to watch David's previous webinar. Maybe essence of portfolio management, maybe it's not yet on Bursa Marketplace, but you can find them on our YouTube channels. Yeah, to watch our recording. So yeah, with that, hope to see you all next Tuesday. Now, if you want to reach David, you can email him at alpha@spiralthinker.com.
Yeah, this is a very technical session topic. So if you've got any burning question, right, by all means, please send your question to us. Just don't ask us what to buy and sell. All right. Thank you very much. So thank you again, Chun Xian, for inviting us.
I've seen that there are many comments say very helpful, very helpful,
Thank you very much. Thank you very much for your support.
Yeah, this is a very technical sessions, and glad that you all asked really intelligent questions to David. All right, with that, I wish all of you the pleasant rest of the day, and see you next Tuesday. This is Shane Choo signing off. Bye bye.
All right.
Thanks, David.
Thank you, Chun Xian.